Thanks very much, Jack and Bill, for being here. Bill, we'll start with you. Is it sell in May and go away with stocks right now, markets at record highs?
Yeah, I don't think you sell and go away. I think it is worth considering kind of bringing yourself back to a more neutral stance on stocks, not getting too extended since it's been, I'll combine it with a couple of things just because we've run so far so fast. I think, odds are obviously, it's an easy one to say, odds are in the favor of returns to slow down somewhat. Although when you hit new highs, you tend to continue to hit new highs for a while. So I don't know that you have to rush, but I think it's worth, kind of pulling back in the horns a little bit here.
All right, so pulling back the horns, I mean, Jack, you're an equity portfolio manager. Are you pulling the horns in, or are you feeling a little bit more, I guess, bullish about what's happening with stocks at record highs? And if so, what sectors are you looking at?
Well, we're certainly constructive on the market. I don't think it's a sell in May and go away. And instead, I do think, though, we keep talking about the velocity of the move that we've seen this year. But I think it's really much more of a bounce back off of the velocity of what we lost effectively in November and December. And if we look not over on a 3-month or 4-month basis, but over a 6-month basis, the market's been more or less tracking a more modest sort of pace that more or less migrates or moves along with earnings overall. And so with that in mind, the focus comes back to earnings, and we continue to see good earnings momentum in the technology sector. You're starting to see some industrial companies start to perking up, and the financials have come back to life of late as the yield curve has steepened. So I think that there's a lot of signals which suggest that there's gains still to be had.
All right, Bill, it seems like a long time ago that we were worried about global economic growth slowing down, the U.S. possibly participating in that global slowdown, interest rates falling, stocks falling, and everything else, and we've totally reversed course. Is it a justified move in your mind? Is the economy here in the U.S. and around the world supportive of the equity valuations we're seeing both here and abroad?
I think it is. I think the only thing I would say is that you have a situation where good expectations are now baked back in. It was, I'll be honest, I thought it was a little bit easier before when we were down because obviously a lot of really bad expectations were in there. But yeah, I think you're seeing China coming back. The U.S. data, obviously, well, on the probably better, not quite as good as what the numbers on the surface would say for the first quarter, but still fine. It'll be really tough. You'd have to work really hard to get us into a recession this year. I'm going to knock on wood, but I truly believe that it's a low probability item.
All right, so low probability, Jack. It also kind of pushes us forward towards the big event for this afternoon. That is the conclusion of the 2-day Fed interest rate meeting. We're not expecting a lot of fireworks. The markets in general are not, but the Fed is a key focus for the markets. They've arguably been a force to the upside for them. What are you expecting out of the Fed today?
I think, honestly, a whole lot of nothing out of today from the Fed. I think they'll be focused on the commentary. They'll be focused on the dot plot. And there is still this idea from the bond market's perspective that you are going to continue to see reasonable odds of the next move being a rate cut. And I think you compare that to, say, what copper markets are suggesting, oil markets are suggesting. You're not seeing the global slowdown that might be a justification for that cut. And if anything, the fact that we had a much better than expected GDP report for the first quarter, really the biggest positive economic surprise over the past several months, I think is suggestive of the hold stays. And to bring it back to where you started this conversation, this idea of we are seeing the most substantial move up since 1987, unfortunately, I kind of remember 1987, and the backdrop then was sharply higher interest rates. We are not seeing that today. So we do see a fixed income market, interest rate markets, which is recognizing that positive but more muted growth on a global basis and not really offering you a competitive alternative to the equity market right now.